Yeah. Now the issue of discussion is a landowner has given the land. In return, the landowner is getting around 6 flats. Now, this has to be divided into two parts. So, calculation capital gains in stage one and capital gains in stage two. So, capital gains in stage one, that is, will calculate capital gains for giving up the land, giving up the land for in return for flats. So, it's a sort of barter. So, transfer includes exchange. It need not be for consideration, need not be in cash. Barter, that is exchange of items, that also is considered as transfer for calculation of capital gains. Now, so here the landowner gives the land and gets 6 flats. So now, in this case, land is being exchanged for flats. So it's a barter. So it comes under transfer. So capital gain will arise. Now, normally, how do we calculate capital gains? Full value of consideration. We will deduct cost of acquisition. Then, whatever capital gains come, either the capital gains will be long term or it will be short term. Now, when the person gives the land, let us say the person gives the land in year one, tax year one. Now, the builder builds the flats maybe around it depends on the size of the construction and any project delays or whatever practical difficulties, all that. Let's say it took almost 4 years. So year one, tax year one, the landowner has given the land. The flats got constructed in year five. That means almost a gap of 4 years. Now the question is, as a general rule, capital gain will arise in the year of transfer. So, theoretically speaking, here, year one, capital gain will arise. So, tax liability has to arise in year one, theoretically speaking. But as per section 45, the taxability will be postponed to the year in which the flats get ready. That is, completion certificate is got.
Is issued, right?
So the year in which the completion certificate is got, let us say year 5, even though transfer happens in year 1, we will calculate capital gains in year 5. That is the year in which completion certificate is got. What is completion certificate? So it is complete so that it is ready to occupy. That's what. So sanitation, water facility, or all other amenities. It is ready for occupation. Completion certificate, or only building is ready. No amenities are there. So the authority may not give completion certificate, or even so. The point is whether amenities are ready, amenities are not ready is not the criteria. Authority, based on certain parameters, if they have given completion certificate, the year in which completion certificate is got, that year we calculate taxability. So in this example, year one, the landowner gave the land to the builder. They entered into a joint venture agreement in year one. Year 5, completion certificate. Flats are ready. Completion certificate is got from the authority. So completion certificate, the year in which the completion certificate is got is year 5. So we will calculate capital gains in year 5. We are calculating capital gains in respect of land that is given. We are talking from the angle of landowner. Right now, we are talking from the angle of viewpoint of landowner. Now, capital gains we are calculating for land that is transferred, land that is given up, land that is given up, that is land that is transferred. So here we are calculating capital gains in year 5, year of calculation of capital gains. Now, full value of consideration. Now the question is, what is the full value of consideration? In the year of, in year 5, in this example, the year in which completion certificate is got, that year, whatever is the fair market value of flats that is received by the landowner from the builder, the fair market value in the year of completions, year in which completion certificate is got, that fair market value on the date of completion certificate, the year, the date on which completion certificate is got, that date, that year, whatever fair market value is there of the flats, that we will take it as full value of consideration along with any other cash element that is received from the builder. If the landowner gets any additional cash element, cash from the builder, that also will be added. So fair market value of the flats that are received to whatever cash element that is received, that is taken as full value of consideration. Deduct, we will deduct cost of acquisition of the land. Now, cost of acquisition of the land. So, fair market value. Suppose the land is got from generations, grandfather, father, or great grandfather, something like that. Inherited property. Then we will take cost of the land, the value as on 1st April 2001. That CAA table, new CAA, the latest CAA table. That is the only latest CAA table, cost inflation index. So now, cost of acquisition we are calculating. If it is whatever is the actual cost of acquisition or cost of acquisition plus cost of improvement or any, if any, or if the land is an inherited property, then we'll take the value as per CAA table index, whatever value will apply and calculate as per CA table April 1, 2001. So we are taking cost of acquisition. So full value of consideration minus cost of acquisition, that will give you capital gain. Now cost of acquisition, should we go for indexation or should we not go for indexation? Now another question. Now we are calculating capital gains. For that full value of consideration we have taken, we are deducting cost of acquisition. Now, cost of acquisition, should we go for an indexation or should we not go for an indexation? If the asset is bought before 234, we have to remember this number 234. If the asset is bought before 23rd July 2024, 23rd to 3 July 2024. So 234, 23rd July 2024. Before that, if the asset is bought, if the land is bought, and if it is held more than 2 years, then it will become a long-term capital asset. Indexation benefit, it's an option, it's not compulsion. It is an option, it is not compulsion. So indexation benefit, the assessee can apply, assessee can take the indexation benefit, but long-term capital gain will be taxed at the rate of 20%. Whatever resulting capital gain, full value of consideration minus cost of acquisition, long-term cost of acquisition, result, whatever long-term capital gain comes, that will be taxed at the rate of 20%. If the assessee is going for option of indexation benefit, then capital gain will be taxed, long-term capital gain will be taxed at the rate of 20%. Suppose the assessee doesn't want to, asset is purchased, asset is acquired before 234, that is 23rd July 2024. But the assessee doesn't want to go for indexation benefit. Assessee doesn't want to take indexation benefit. It's an option, it is not a compulsion. Then, without indexation, cost can be deducted, capital gains can be derived, arrived. Whatever capital gain, long-term capital gain comes, 12.5% tax will be levied. So here we discuss two issues. One is cost of acquisition, reduction of cost of acquisition, whatever is the actual cost and cost of improvement. If the asset is bought way back or inherited property, something like that, then value as on 1st April 2001 will take. Another issue, should we go for indexation or should the assessee can take indexation or not? It's an option. If the asset is bought before 234, what is 234? 23rd July 2024, then indexation is possible, but tax will be paid at the rate of 20%. Asset is bought before 23rd July 2024, 234, but assessee doesn't want to go for indexation. Then whatever actual cost will take, whatever is the capital gain, long-term capital gain will be taxed at the rate of 12.5%. So it is whichever is beneficial to the assessee, it can be given. So how are we arriving capital gain? Long-term capital gain. Here, how are we arriving capital gain? Full value of consideration minus cost of acquisition. Result is capital gain. If the asset is held more than 2 years, period of holding is more than 2 years, then it will be long-term capital gain. And if the period of holding is less than 2 years, then it will be a short-term capital asset. Result will be short-term capital gain. Now that short-term capital gain will be taxed at normal slab rates for an individual or HUF. So for other entities, whatever is the rate of tax as usual. So short-term capital gain for individuals and HUF, it will come under slab rates. And for others, whatever other entities, the regular routine calculation. So right now we calculated capital gain for stage 1. That is, from the viewpoint of landowner, we are calculating capital gain for land that is given up, land that is transferred. So the assessee has got the landowner. Here the assessee is landowner. The landowner has got 6 flats in our example. Now these 6 flats he sells in year 7. Let us say he sells in year 7 and he sells in year 10 and he retains 2 flats. 2 flats he will sell in year 7. Year 1, land was given, joint venture agreement was entered. Year 5, flats came into his hands, completion, year of completion. Year 7, he's selling 2 flats. Year 10, he's selling 2 flats, and other 2 flats he is retaining himself. So year 7, when he sells 2 flats, whatever sale consideration, whatever is the sale consideration we arrive at, that is either stamp duty value or whatever is the sale price. Sale price or stamp duty value, whichever is higher. Sale price or stamp duty value, whichever is higher, that is full value of consideration. Minus, we are right now we are in stage 2, calculation of capital gain for flats. That is, it is building now. Only for, we use the word land only for plot of land where there is no superstructure. Once a superstructure comes upon the land, it is no more called a land, it is called building. So now there is a superstructure. Each flat has got its allocated land space, allocated share in land space. Now we call it as building. He's selling flat. Two flats is sold. Whatever price we are calculating, whatever price he's getting, that is full value of consideration, stamp duty value, or actual sale price, or stamp duty value, whichever is high. That is full value of consideration. From that, we deduct what is the cost. Earlier, in year 5, in our example, in year 5, we had taken fair market value in the year of completion of where the builder got completion certificate from the authorities. We have taken fair market value. That was the full value of consideration from the angle of land. The same amount will become cost for sale of flat. So fair market value in the year of completion, flats got completed. Completion certificate was obtained in year 5 in our example. So that year, whatever was the FMV, it has got dual role. It will play double role, dual role. So from the angle of land that is given up, that will become fair market. That fair market value will become sale price for the land given up for calculating capital gains in respect of land. In stage 2, the fair market value in the year in which completion certificate is obtained, that same fair market value will become cost when the flat is sold in the later year or same year. So year 7, the flat is being sold at price X. So price X or stamp duty value, whichever is higher, minus stamp duty value in year 7. Stamp duty value in year 7 of the flat, or actual price for which the flat is sold, whichever is higher. We are talking from year 7 now. Minus FMV in year 5. FMV of the flat in year 5, that is year in which completion certificate is obtained. That is a dual role it will play. Year 5 value. FMV of year 5 plays double role. So year 7 FMV minus year 5 FMV of the flat, the difference, that will give us capital gain. So year 7, if it is less than 2 years holding period, so then year 10, he sells the thing at, let us say, price P. So price P, he sells the two flats. So price P, actual price, or stamp duty value, whichever is higher in year 10, minus FMV of two flats as on year 5, in year 5, that is as on date of completion certificate is obtained, date of completion certificate. So difference between two FMVs, year 10 FMV or stamp duty value, year 10 actual price of stamp duty value, not FMV, year 10 actual price of stamp duty value of the flat minus FMV of the flat in year 5. The difference what we get, that is capital gain. So year 10, so here, if the asset is held more than 2 years, it is long term. If the asset is held less than 2 years, it is short term. So year 10 asset will become year 10, the asset is sold. Year 5, he got it. In the example, assessee got the flat in year 5. He sold the asset in year 10. Period of holding is greater than 2 years. So obviously it's a long-term capital asset. So long-term capital gain. So here the point is, flat, is it held for more than 2 years or less than 2 years? If it is held for more than 2 years, it will be long-term capital asset, long-term capital gain. If it is held for less than 2 years, it will be short-term capital asset, short-term capital gain. So this is stage 2 calculation of capital gain. Stage 2 calculation is being done for transfer of flat, transfer of building, transfer of superstructure. Stage 1 calculation is done for land that is given up, land that is transferred. Stage 2 capital gain calculation is being done for flat that is transferred. So if the flat is held more than 2 years, it's long-term capital asset, long-term capital gain. If the flat is held for less than 2 years, it will become short-term capital asset. Short-term capital asset. Resulting gain will be short-term capital gain.